How is the increase in AI data center debt impacting the bond market? Hi, I'm Dan Larkin. In this video, we'll dig into what the increase in borrowing to finance AI data centers means for fixed income. I'll also talk about the trade-offs advisors should consider when thinking about an allocation to gold in their clients' portfolios. And we'll address the top fixed income questions we're hearing from advisors. Investors are looking ahead to 2026, and one of the most common fixed income questions they've been asking is whether the bond market can repeat its strong performance again next year, and what should they do to position their portfolios for continued success. Bonds provided strong returns and portfolio stability in 2025. All bond market sectors have posted positive returns, with the broader U.S. market up over 7%. This year helped prove the point that starting yields matter. For example, year-to-date, more than 50% of total U.S. bond market returns have come from coupon payments alone. Our outlook for 2026 anticipates supportive conditions to carry into next year. We see U.S. growth pushing above 2%, driven by continued AI-related business investment and supportive fiscal policy that could help mitigate the drag from higher tariff rates. The Fed is also expected to continue easing, and while we don't think that they'll deliver the same amount of cuts currently priced into markets, their proactive stance will be supportive for fixed income. Our base case view is that Treasury yields and credit spreads will be able to hold near current levels, meaning that income may again be the primary driver of market returns next year. Investors can find value in fixed income today by locking in attractive yields and focusing on diversification across market sectors to add additional return stability. Despite our supportive market outlook, we still think it's appropriate to be more cautious in lower quality credit, since the yield advantage is not enough to compensate for their higher sensitivity to downside risks. The massive build-out of AI infrastructure is not a new story, but the impact has only recently crossed over as a main theme for bond investors. AI hyperscalers have been the model for self-funded growth in recent years, but recently they've turned to the bond market to help finance a portion of their investments. Over the last few months, for example, 5 of the largest firms have issued more than $120 billion of new bonds into public markets. That's important for a few reasons. For one, the surge in issuance came at a time when U.S. investment-grade credit spreads were near the tightest levels of the last 30 years. The size and pace of this new issuance overwhelmed the market and ultimately gave our team the opportunity to add exposure to these very high-quality companies at a much better price than they typically trade at. The second reason it's important is that this trend is expected to continue over the coming years, which will create new investment opportunities. We've already seen a variety of creative funding structures linked to AI investments, but it also means that there will be more total bond supply for the market to absorb going forward. In 2025, the supply-demand mix for corporate bonds has been balanced, but higher supply in 26 and beyond could put upward pressure on spreads if it's not met with an increase in demand. From our credit analyst perspective, most of these companies are starting from a position of very low or no debt and have healthy cash flows from existing operations. So their credit quality remains very high. But as the theme of AI investment continues, that may not be the case for all companies looking to keep up with this trend, so it'll remain a key focus area for our investment teams. Gold has certainly received a lot of attention this year. With prices up more than 50%, we've been getting more questions about how to think about its role in a portfolio relative to the fixed income allocation. Just like every investable asset class, gold offers a specific set of characteristics that can be valuable to an investor's portfolio, but just as with every investment decision, there are important trade-offs to consider. If you look at long-term performance, the average return for gold has been between the averages of the U.S. stock market and the U.S. bond market. One of the advantages is that it has a very low correlation with both stocks and bonds, so it has very attractive portfolio diversification benefits as an asset class. It also tends to hold its value well in inflationary environments and when currency valuations decline. The opportunity cost is that it does not provide any income. It doesn't pay interest and it doesn't pay dividends. So its returns come purely from price appreciation. And that means that in some market environments, it can lag those income generating assets. That means that gold isn't a true replacement for stocks or bonds in a portfolio. It's better thought of as a complement to both of them. A well diversified portfolio should have a balance between investments that lower volatility and those that offer growth opportunity. Gold should be thought of as a tool for the long term preservation of value, not for speculation, and not as a tool for market timing. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.